Good morning. Good morning. You're so dedicated to be here. Sorry I'm late. I was organizing the files and sent them late to you. So if you would please open the 6.1 document, 6.1 that I sent you. We're going to go a little deeper into capital structure, and I'm going to show you what I need from you, and you should be able to get through the assignments I've sent. They're just 2 with solutions, and throughout the day, if you need some help, you can let me know, but once I get through this, I think it should be straightforward. Okay, so what we're going to talk about is capital structure. Remembering what we learned before, I'm going to answer, or we're going to look at answering 2 questions. Remembering that the value of the firm is valued by its assets, and the value of its assets in the balance sheet are equivalent to its financing. Okay, so debt and equity, which we learned how to compute. So I left you with some exercises to work on that. And so these are the market valuations. And the value of the firm is equivalent to the market value of debt outstanding and shareholder equity outstanding. So the question becomes, from the perspective of management, the firm, what should they be aiming at? Should they be aiming at maximizing the whole pie? So that the value? Or is that just the same as maximizing shareholder wealth? So we have to keep in mind there's an advantage to debt that we learned about, or we discussed yesterday, and that is that the cost of debt is tax deductible. Okay, and I'm going to sort that, or I'm going to include that in my consideration of debt. So there's some sort of advantage, but from the perspective of shareholder, now they are second in line to receive payments. So shareholders, as owners of the firm, don't like debt so much. They want to be reassured that by taking on debt, the value of the firm actually increases. Otherwise, it's not justified for them. Okay, so the question is, should the firm focus on maximizing the value of shareholder wealth or the value of the firm? The second question, once we've answered that, is what is the best ratio? Is there an optimal ratio between equity and debt? So we refer to it as the debt-equity ratio. Which one will maximize shareholder wealth? And so I'm giving you the answer to the first question that I'm going to address right now. Okay? All right, so stay with me as I work through this. So here's an example outlining consideration. So U represents the unlevered firm. So this is an all-equity firm. An all-equity firm, let's say it's valued at $1,000, currently has no debt, just stock outstanding with market value $1,000, right? So that's the value of the firm. There are 100 shares with each priced at $10 a share for the $1,000 of S, or the value of the unlevered firm. So now consider the firm issues $500 of debt. So in other words, they take on bondholders for half the current value of the firm. So they raise this money by selling bonds, and let's say this directly goes to appease shareholders. So the $500 is distributed as a dividend of $5 to the shareholders. So what you have are alternate scenarios. So let's start with the worst case. So these are just the original valuations where debt was 0, the value of the firm was 1,000, and so also shareholder equity was 1,000, market value, or S, was 1,000. Okay, so what about if we float? So we have collected $500 from selling bonds, and it turns out that equity, the valuation, so from the perspective of shareholders, they don't like this too much. Okay, so the value of wealth, shareholder equity, goes down. So basically the market incorporates this information and values stock at less. So $2.50 a share. Well, no, sorry, because there's 1,000. No, there's 100 shares. So anyway, the total, let's look at the total. Okay, the total value is $250. So that makes, if you add B and S, that makes $750 the value of the levered firm. That's what the L is for. It could also stay the same. Maybe there's no impact from the perspective of shareholders. Okay, that would only be possible if the share valuation went down. Debt was the 500, so the value of the firm stays the same. In the best case scenario, the value of the firm going up, that means that shareholder wealth is $750 with the $500 to bondholders. So how does this restructuring, this is capital restructuring, how does it impact, how do we look at the impact of the firm relative to the shareholder? Okay, so it looks like these all went down, but does it really matter for us, the shareholders? Okay, so let's look at that from the perspective of the shareholder. What does the shareholder get? Remember, since the value of the firm went up, the shareholder has to incorporate that, okay, into their consideration. Take that into consideration. The value of the levered firm, I put across the top here. However, notice capital gains, the price of stock. So this was $1,000 before, right? That was the original. Oh, I put it here. Let's put it here. So what I'm going to do is look at the capital gains. Well, it was originally valued at $1,000. Shareholders as a whole have lost $250. So that's a capital loss. In the second scenario, on the same case, they've lost $500. And in the worst case scenario, they've lost $750. However, they've received a dividend, okay, in each case. So we can compute that the payoff to shareholders after the restructure is $250 in the best case nothing in the same case, and in the worst case, they've lost. So what do I care? What this shows is that the payoff to shareholders is positive when the valuation is positive. Okay, so it went up, the value of the firm went up, and so did the payoff to shareholders. The value of the firm didn't change, and neither did the payoff to shareholders. And in the worst case, the value of the firm went down, and that's a loss to shareholders. So the point is that when the value of the firm is high, so is the value of shareholders, as seen here. So, in effect, shareholders should care about the firm value. Okay, they are the direct beneficiaries or the losers in that case. So they shouldn't just care about their own wealth. They have to look at the big picture, where debt can actually play a role in increasing value. We didn't do much, but by issuing debt, in the case that it has a positive impact on the value of the firm, it also has a positive impact from the shareholders' perspective. So I'm demonstrating that shareholders do care about debt and the overall value of the firm. All right, so what I'm going to introduce you to, if you've never seen this before, are the propositions of Modigliani and Milner. These are financial economists who characterized answered the question is what they did. They answered the question regarding the optimal debt to equity ratio. All right. So the first question was that we've answered, should management aim at V or S? So we concluded that since shareholders care about the value of the firm, it's fine for them to care about the value of the firm. They should care about the value of the firm, and that will influence, and it can positively impact shareholders. So shareholders care also about the value of the firm. The second question about the optimal debt to equity ratio, the capital structure, is a question that was tackled by this pair, Modigliani and Miller. What they did, as theoreticians do, they abstracted as much as they could to get certain results. Okay, so the first result is known as Proposition 1. They assume there are no taxes. So what they've done is they've abstracted away from debt being from the fact that having debt is actually a cost savings to the firm. So they've taken that possibility away by eliminating taxes. Now this is not realistic, but it's just to build towards a more realistic case. So we begin with the case of no taxes, and we make some other assumptions. So there's no risk of default. So there's no risk that the firm will actually go bankrupt. So that we take on bondholders and they're guaranteed to be paid. Cash flows are perpetual, so this is from the perspective of stockholders. They're going to get their dividend indefinitely, so the firm's going to survive forever. We assume firms and investors can borrow and lend at the same rate. And as I said, there's no taxes. So with all of these assumptions, we're going to demonstrate that it doesn't matter, that the value of the firm with debt is the same as the value of the firm without. Okay, unlevered means no debt, levered means with debt. So here's the example. This is the current state of the firm. It's unlevered. It's $1 million value. So the shareholder wealth outstanding, or that stocks outstanding, are valued at $1 million. No debt. So the question becomes, what if the firm issues $400,000 of debt at 5%? This is the interest paid on debt, or the yield to maturity. So keeping in mind that firms and investors can borrow and lend at the same rate, and there are no taxes, we're going to use Y to represent the dollar return on the firm's assets. So that's like the payoff. All right, so from the perspective what I'm going to do from the perspective of a investor with this firm, observing this firm, they could take on strategy A. They could buy 10% of the stock in the levered firm. Their dollar investment would be 10%, so they get their 10% share of all outstanding stock, right? Which would be equal to 10% of, this is just the value that goes to stockholders after bonds are paid. So this is the value of the firm minus the value to bondholders. They get 10% of that. So that's kind of the same thing. So S is V minus V. That's the investment. What they get, to be clear, so this is what they're investing in the firm. What they get is just what I said. They're going to get the value after bondholders are paid. Bondholders are paid their return to debt. So that's a fraction for every dollar invested. They get RB. So that'll be multiplied by the amount invested. The shareholder will get 10% of that. So this is the dollar return. Do you see? So this is, I said this is the rate, 5% is a return to debt, and it's $400,000 that was issued. So this gets paid from the total dollar return. Y. Shareholder at 10% gets 10% of that. All right, so what about an alternative strategy? Instead, an investor looks at investing in the unlevered firm. Investing in the unlevered firm and borrowing 10% of the value that the levered firm has floated in debt. So this can be done in the market, right? So this was an assumption. Essentially, an individual investor could either invest in a levered firm or create their own equivalent return by investing in the unlevered firm and borrowing the equivalent amount in debt. their dollar investment would be identical. Their dollar return would be identical. Mathematically, these end up being the same. So since the dollar return from A and B is identical, the initial cost of both strategies must be identical. Okay, this is because of efficient markets. There should be no arbitrage opportunity. So if you equate these two, this and this, it turns out that you will solve and find that the levered firm is the same value as the unlevered firm. There's an L and a U there. So what this says is, since an individual investor could, with an unlevered firm, just create their own equivalent amount of borrowing, if given all these assumptions, then there's no difference between a valuation of either firm. So the firm value is not affected by leverage. So value is not affected by taking on debt holders. This is M&M's Proposition 1 with no taxes. That's the best explanation I have for you. I also have it summarized in a graphic. Here we have the debt to equity ratio on this axis. No matter what the debt to equity ratio, the value of the firm from unlevered to adding debt, so this is going to add debt as you go, is no different. So this is a starting point. This is where there's no difference. To have no difference, borrowing and lending at the same rate should be possible, and there's no taxes. So that's just like a baseline. So from here, we go to Proposition 2. Still no taxes. So we could get the WACC for the firm, right? The WACC is like this. Now, there's not the 1 minus TC factor here because there are no taxes in this model. If you are to rearrange this to find the return to equity, so solving this for the return to equity, so all I've done is isolated this. So the return to equity is then equal to the return to investors, so the average investor in the levered firm, right? And then the return to equity is higher than that, depending on, so we know that RB, the return to debt, is always the lowest, right? Because it's always lower. The return on debt it's less risky, so it's going to be lower than the return on equity. And of course, the return on the unlevered firm will be at some point between those, right? Because this is a weighted average. So it turns out that the return on equity, actually, this is going to be a positive and this is going to be a positive. So it's going to be higher. The return on equity is going to be higher than the return to the unlevered firm. So this is a firm just with issuing risky asset The return to the unlevered firm is the risk inherent in the firm's operations. This is the beta of its assets that you would use to compute this, right from the CAPM. But the return to equity is more than that. There's also that financial risk, the fact that they have to share with debt holders. So because of taking on additional risk, even though we've explained that the value of the firm is equal, that is unlevered, is equal to the value of the unlevered firm in this scenario, the more and more debt issue, the higher the required rate of return for stockholders. Okay? So this is always going up with the debt to equity ratio. So here's the return on debt. It doesn't change. It's constant with the debt equity ratio. WACC would be the same because the value of the firm is going to be the same. But the return on equity is increasing. And this reflects how I explained to you, they don't like debt, but they're compensated in the fact that the value of the firm isn't affected. So if you think about our capital budgeting exercise and the interest tax shield, I'm going to include that now. So we're going to work on introducing back taxes. We're going to keep the assumption that cash flows are perpetual. So that's the dividend continues indefinitely. There's no depreciation, so we don't have to work with any kind of investment and depreciation. There's no fixed asset either, and there's no net working capital spending. So I made this very simple. And what we've computed are the returns for the unlevered firm and the levered firm. So this is, we're bringing taxes back. And what do you see? So this is familiar. This should be familiar to you. For the earnings before interest and taxes, let's say it's 200. And the firm is considering going to $500 debt at 10%. The taxes paid on 40% of the 200 earnings means they're going to pay $80 taxes. The net income is $120. So we would say the cash flow from assets would be $120. So this is after tax. If the firm were levered, there would be an interest payment made, right? 10%. Okay, so $400 of debt, they have to pay 10% interest to the bondholders. And that is used to reduce taxable income to get this amount. So now you're calculating on 160 So that's the difference of these, right? 160 times 0.4 gives you $64. That's your taxes. Your tax has gone down. So keep in mind that sorry, I was interrupted. So the cash flow then from assets would be as a result of the tax savings. See, your taxes have gone down by $16. So tax flow, so this, you've seen this figure before. This is computed from the tax shield. Okay, so this is now, if you can see that, this acts as a tax shield for the firm. So we're going to incorporate that. This is only in one period. But as we assume, the cash flows are going to be considered perpetual. So that includes dividends paid and any tax savings. So what is the link between debt and firm value? Since interest creates a tax deduction, borrowing creates an interest tax shield. Its value is added to the value of the firm. So what are we adding? Well, just like we would have to discount this perpetually, so it's a perpetuity, and we get a value for it. We do the same thing here. So this shows you with taxes. So all I've done here is I've added with taxes, bringing back taxes. The value of the levered firm is a markup above the unlevered firm by this tax saving, the perpetual tax savings. So we see that graphically. Okay, sorry again. All right. So this is how we see this visually. So this was without taxes. This is what happens with taxes. Perpetual tax savings. Okay, so this is perpetual tax savings, infinitely receiving tax savings. You see the value of the levered firm is higher. So this is the axis of debt and the value of the levered firm. And so now let's try an exercise to solidify. So the cash flows are higher and levered because of the tax savings. So let's look here. So the earnings before income, interest, and taxes is 100. So interest paid to debt. The tax rate is 30%. The return to the unlevered firm is, return to shareholders. So this is the WACC. For unlevered, this is just the return to equity. Suppose that the debt, so there's restructuring, so that the debt goes from 0 to 100 at 10%. What happens to equity value? So use the formulas above to compute each of these. Okay? I'll give you a few minutes. All right. Sorry. So this is what you're doing, right? So you have 560 would be the value of the unlevered firm. The levered firm would be adding the perpetual tax savings. And then to figure out the shareholder value, what do you get? You're going to take this amount. Well, let's calculate this. $590. And so that leaves 590 minus the debt. The debt is 100. So shareholder value went to 490. Okay. So this is how you would compute for debt with taxes. So the value of the firm went up, and since that's important to shareholders, although their stock valuation has gone down, they are duly compensated by the fact that the value of the firm went up. So how do we see that in terms of the WACC with taxes? Now I'm going to put in the 1 minus TC term. And we can compute from here the return to equity, and you'll see it goes up. And then the WACC. So let me give you some time for that. Okay, so you're using the information that we were given. You're going to compute now the return to equity. And the WACC. Remembering now we're going to have bondholders and stockholders, so the WACC is different from the return on equity. So let's use this expression to compute the return on equity. So this is 12.5. Let me know if you get this or you get something different. So I'm taking the values from here. What do you get? Should it be higher or lower? Anyone? Very good. So it goes up, right? I have no room. And I can keep it to 4 decimal places. 6 decimal places. All right, so that's higher. It's higher than 12.5% because the sentiment of shareholders is that they've taken on creditors, and creditors will be paid, bondholders will be paid before shareholders will be paid, and that makes them a little more demanding. So the return goes up, the expected return goes up. Okay, so what about the average investor in the firm? What will that be? What will their return be? So the return on capital, or cost of capital, the WACC. So use the formula above to compute the WACC. What do you get? So you should be using the formula here, the weighted average cost of capital All right, so Alex sent his WACC. How about you guys? Everyone else? Anyone else? So WACC is S over S plus B. I need an extra page, don't I? You guys are getting the same number? Very good. Anyone have any questions? Okay, very good. So you're putting in, this is 490, B is 100, RS we just computed. So, keep 6 decimal places, I guess, if you write it as a decimal. That was 10%. And the tax rate was 30%. If you put all those things in, people are telling me you get about 11%. So the WACC is, remember, the WACC is a weighted average of the return on equity and the return on debt. So I'll give others a few minutes, catch up. Let's see a few more of you. See if you got it. Okay, good. All right, so that's it. Those are the formula that you're going to work with. What you're seeing is this is a summary of Proposition 2. Okay, so there's Proposition 1 with taxes, Proposition 1 without taxes, and then these Proposition 2 refer to the cost of capital. Okay, the others are focused on the relationship between, you see, value of the firm and the debt to equity ratio. So that's Proposition 1 deals with this relationship. Proposition 2 deals with the cost of capital. And so, with taxes, what we see is that the return on equity, expected return on equity, has to go up as the debt to equity ratio increases. This is the return on debt that's constant. It doesn't change. It doesn't matter how much debt to equity is issued. It's always the same because that's guaranteed. This is just a marker of the baseline, the return to the unlevered firm. And you see the more debt there is, right? Remember, WACC is a weighted average. So if there's more debt issued, the fraction in front of the return to debt is greater, right, than that in front of the return to equity. So this WACC looks more like the return to debt, cost of debt. All right, so what? So what we figured out is if debt is allowed, if there's taxes and there's no risk of default, that's the major assumption here that allows this to go indefinitely. There's no restriction then on how much debt to issue, because show you with taxes and the perpetual tax shields, there is no barrier, there are no boundaries to the value of the firm. And if stockholders care about the value of the firm, then stockholders want an infinite amount of debt. That's what it says. So this is with those assumptions in play, that's what this is saying. And now we know realistically that's not possible, because at some point there's going to be concern or financial distress that the firm has taken on too much debt and might be unable to pay the debt holders. Okay, so when we reintroduce the possibility of default, financial distress, things change. Okay, so that's the next phase. So M&M with taxes, debt provides tax benefits to the firm. The firm should borrow an infinite amount But in reality, so I'm just summarizing what I just said, in reality, the firm has to pay interest and principal to bondholders. If the firm defaults on a payment of to its bondholders, it will enter a phase of financial distress, or ultimately, if financial distress persists, the firm will declare bankruptcy. There are costs involved in both financial distress and bankruptcy. There are direct costs, the legal and administrative costs of lawyers, accountants, and expert witnesses to attest to what's happening, to deal with any kind of claims from bondholders as a result of not paying them on time. And then there's the indirect costs. Maybe you're going to lose consumers or buyers or clients because they see that there's an instability in the firm and they don't want to continue the relationship. You also have to be concerned of agency costs. So these are the result of managers and stockholders that may engage in selfish strategies. Okay, they could be incentivized. The managers could be incentivized to take large risks, and shareholders would support that. So if they think the firm is going bankrupt, well, why don't we invest in all or nothing projects? It's not going to matter in the end, because if anyone gets paid, it will be the bondholders. It won't be the shareholders. So they're going to do their best to extract value before the firm goes bankrupt. They might pursue underinvestment. So even though after financial analysis it's determined that projects are positive NPV projects, they might not be invested in, and instead the capital is distributed in other ways for shareholders to benefit. They may liquidate dividends, shut down plants, sell parts of the firm and distribute it as dividends. This could be viewed as illegal. Okay, so there's I've itemized them 1, 2, and 3, but just to give you an idea. Even managers maybe they'll buy office furniture or buy software or systems that they can take with them when the firm ends operations. So they might increase perks, so they distribute the funds before bankruptcy takes place. So this is all waste. It's all inefficiency. Okay, and they put them under the title of indirect costs of financial distress. All right, so how does this work out? How do we include that? What we're going to do is augment the formula. The value of the firm is equal to the value of the unlevered firm plus perpetual tax shields minus the present value of expected costs of financial distress. For firms with a low financial leverage, the probability of default is 0, so this term will just be 0. A $1 increase in debt will increase the tax benefits and the firm value at a constant rate of TC. For highly levered firms, the probability of default is positive, and this term will be positive. So although for $1 increase in debt, you'll get an increase in tax benefit at a constant rate of TC, there's increased costs of financial distress at increasing rates. So what you see, we can visualize this as this. Early on, so you realize that as you increase debt, there are benefits, the perpetual tax shield. However, at some point, financial concerns or costs associated with financial distress kick in and lower the value of the firm. So here would be great to identify what that is. What is the optimal level of debt? This is the highest before financial distress decreases the value, okay, but a little higher than, well, it'll just mark where's the highest point, the optimal level of debt. All right, so I'm not going to get too heavily into this. We're really done the notes, but I want you to work with these propositions. So that like the 4, so proposition 1, 2, with and without taxes, and then this concept of financial distress and finding optimal level of debt. Now this, to find the peak here, this should be familiar to you. Solving an optimization problem. This is actually involves some calculus, and I think I've left that out of the problems that I sent you. Let me double check. But essentially, you know, you can find that solving for the optimum. So it's very interesting. I need to teach you this so that you carry that on to your other classes that you'll be taking. And there's lots more to do here, but given the short course and the test being tomorrow, I'm not going to delve too much into this because I would actually have to do a little bit of calculus review. So you need to know this model, you need to know this happens, and the formulas that I've taught you before. So we can look at the exercises, and you'll see that very similar to what we just did. So if you didn't get it, you're going to get some practice now. Yeah, see, I didn't give you any of those, but anyway, so that's it. So what happens with the return? So we talked about in the first graph, this is the value of the firm on this axis, the maximum level of maximum firm value for total debt. But then we also have to consider the cost of capital. They come in tandem, they come in pairs. So what you see is there's also a minimum cost of capital. Okay? Because after this optimal leverage, if more debt or debt relative to equity is issued, investors, even bondholders, you see, require a higher rate of return. So this goes up. So the expected return to debt holders in a firm that's in financial distress will increase, and so too the WACC will increase. So we would adjust the formula for a premium, with a premium for cost of financial distress on top of the WACC. So these are adjustments to the formulas you have. These last 2 pages, I'm not going to test you on, but you should know that, okay? And it's simple, not simple, but it's straightforward once you're shown how to do this, to find this optimal level B star using calculus, and then calculating the WACC and the premium to get, well, you could get a WACC up here. Okay, so that's it. So let's do some of the exercises. And like I said, the last 2 pages I'm not going to test you on, just because I'm going to end up going into uncharted territory. I think you all should have calculus by now, so that shouldn't be a challenge. But I'll leave it to your other instructors to teach you. So let's see. We have I've also given you some connect questions on the chapters, relevant chapters. So you have that, and I've made it due, I think, on Monday night. So I have time to put the grades together for Wednesday. So let's see, the review. No, let's do the other one. Should we do this one? Okay, let's look at this. So I said, do not round intermediate calculation. Final dollar answer should be rounded to 2 decimals. Final interest rate should be rounded to 4 if stated as a percent, or 6 otherwise. Final answers indicating periods should be rounded to whole periods. All right, so assume. So this is review 1. Assume that M&M holds. So those assumptions that I set out in the beginning, without taxes. The risk-free rate of return is 4%, and the market risk premium is 10%. XYZ Corporation could be financed with debt and equity according to the propositions specified in the table below. Proportions. Fill in all the missing cells in the table below. So where should we start? No idea? You should start at the top. So here you have 100% equity finance firm. You can find the expected return using the beta for risk. So use the CAPM to compute the return from the risk. And and since there's nothing else, it's just equity, this weighted average beta will just be the same. So this would be 1.2 here, and then using 1.2, since there's no debt, these would be the same as well, expected return to equity and the WACC. So you can calculate both of those using the CAPM.
I use the lowercase now version of the formula, even though I'm using capitals before. I hope it doesn't confuse you. I'm going to use E. So that's the CAPM formula. The return on the risk-free rate is 4%. This is 1.2. You don't have to make the table, but you should be able to fill in a table, John. This is 1.2. And the market risk premium they told you is 10%. So this is just CAPM. So you can think of this as an application of WACC and CAPM. So when you put this together, you get %16. So that goes over here. So this is 16% here and 16% here. Okay, so we finished the first row. Next row. Now we're going to introduce some debt. So only 80% is equity financed. How does it change the numbers? What do I do? Okay, so for the next one, you're told with 80% equity financing, they give you the expected return. So it's going up. Remember the chart, right? For cost of capital will go up when you introduce bondholders. The cost of equity will rise. So this goes up, and I give you the number, and then you can figure out column 3. Column 3 can be figured out using either CAPM or because also you see the beta has changed. Return goes up, risk goes up. You've also been given the debt beta. Okay, so you match the debt beta with the cost of debt. So you can use CAPM for that. You don't need to do anything with these because you have that. And then you calculate WACC. So that would be the step. So do this first. So use CAPM for that column. I can't read. Okay, so use CAPM. Tell me what you get. I mean, I gave you the answers, but try not to look. So you're going to calculate now RB. Equals RF plus beta of debt times the market risk premium. And so for, see, the betas are low, right? Because there's low risk. All right, and you get 0.052 or 5.2%. That's correct, Alex. You guys getting the hang of this? Well, the risk-free rate is 4. The debt beta from up here is 0.12. It's given to you. This is the market risk premium. And that's your result. That's right. So you put that number up. Return on debt. Good, John. Okay. What's next? So next you can calculate the WACC. Having this and this, you can get the WACC. So this is just reapplying CAPM and CAPM, but also we are going to have to use in some places we have to use the formula we learned for return on equity for a levered firm from an unlevered. That's also going to be useful. Okay, so let's get WACC. You can do a weighted beta for the weighted average beta, or you can get the WACC and do a CAPM to get this. Notice there's no taxes, so we don't have to worry about the 1 minus TC at all. And so for WACC, so you're going to put the weight for stock, right? And the weight for debt times the return. So the return on equity was 18.7, and the return on debt is 5.2. And what do you get when you put those together? There's no 1 minus TC for the WACC because, so this was like, this is S over S plus B, RS plus B over S plus B, RB. We don't need 1 minus TC because TC is 0. So what do you get? Are you sure? All right, so you get 16. So it was 16, but it's still 16. Does that make sense? In fact, all of this is going to be 16. Why? All the WACCs will be 16, no matter what the ratio. If you remember, without taxes, so this, understanding what you're doing will make the calculations go much quicker. So without taxes, the result is that there's no difference in the value of the levered and the unlevered firm. So we have the value of the levered on this axis and the debt equity ratio here. And so too, the WACC will always be the same. Okay, the WACC will always be constant, no matter what the debt to equity ratio. value doesn't change, the WACC doesn't change. So that's why it's always 16 all the way across, all the way down. So that's what this says here. Because of Proposition 1, the WACC must be constant. So that's with all the assumptions that we made. No taxes, no risk of default. There's no reason why the investor, the average investor in the firm, should increase their required rate of return. However, shareholders, stockholders will. Okay, but the average investor won't. Okay, let's continue. So that makes all of these calculations much easier. These are all 16 all the way down here. Okay, so these are all going to be 16. And that's all because of no taxes and the assumptions of M&M. It says assume M&M Proposition 1 holds, so that's how you know you can do this. Now the rest of the columns are either using CAPM or weighted. Oh, let's see. Let me do a couple more to show you. So we need just now, so the beta, since the WACC doesn't change, the weighted beta won't change. So these are all 1.2 all the way down as well. So this result is all because investors could invest in this levered firm, or they could create the same structure by borrowing on their own account. So because of that, they can't get additional value doing something else. The value of the firm that's unlevered is the same as the value of the unlevered firm from the perspective of everyone. Okay, so see, we have so many less things to calculate. So again, expected return given the beta, you could calculate this. And equity beta you can get from the CAPM. Alright, so I did give you a formula sheet with all those formula. The only one that I want to talk about right now is here. Let's look at this one. How will you compute this? So for all these, I've given them to you. How would you get this value here? So this is the return without knowing the equity beta. How would we get this? So you don't have the beta for equity to calculate through the CAPM. So you need a different formula. the different formula is going to be someone said we can do the beta of WACC. For this one, if you do beta of WACC to get, all you can get is this from the beta of WACC. I mean, this is going to be a long process if you want to unravel from expected return here. So what you're going to do is use from so the missing formula is, I've given it to you already, but let's put it here. This is it here. So you get this result. This is from no taxes, right? This is Proposition 2. So you can refer to this as the Proposition 2 no taxes formula. You take the WACC, and since the WACC is the same for the levered and unlevered firm, then I could say WACC is the same as the unlevered firm, the return for the unlevered firm, and then solve for RS. So this formula in the box is isolating RS. Now this is the formula that you need, okay? I think that's what Alex was getting at. So RU is where you have 100% equity, no debt. Once you introduce debt, this adjusts. Okay? And then when you have taxes, you have to add an extra term here. So let's take that and use that formula. So what we're going to use is the return on equity is equal to the return or the WACC for the unlevered firm plus the premium or the extra, right? The premium on debt that adjusts for the debt to equity ratio. So use that to calculate column 2. What do you get? I'm waiting for you. Nobody? Not yet? So the return to the unlevered firm investor is the same as return on equity. This is 16%. Then this is 16% minus the return on debt, which is you're told 6.6. And then you multiply it by the debt to equity ratio. So debt to equity ratio is different than percentage. So if it's going to be 40% equity, it means that 40% is this. So how do you go from this, and 60% is this? So how do you go from this to B over S? Do you guys see it? If you wanted B over S, all you'd have to do is take this amount and divide it by this amount. That would give you B over S because the denominators would cancel. So this is actually calculated by 0.6 divided by 0.4, believe it or not. So do you guys see that? Is that clear? Is that messy? Okay. So B over S is what I need for this formula, but I don't have the numbers in terms of B over S. I have the fractions of S over S plus B and B over S plus B. But to get B over S, I should just take this over this because the denominators will cancel. What do you get? Alex, you're off a bit. Okay, so be careful about that. Very good. 30.1. Okay, so that's how you apply that formula. I really that's it. Those are the formula that I need you to work with. We should do a little bit of the second one as well. Okay, so that will give you 30.0 0.1%. And from there, you can calculate the beta of equity. And that's it. So to get the beta of equity, you use to get the beta of equity, you would use CAPM. So this is really exercise. It's a lot of exercise. Exercising your understanding of the formula. You're turning them inside out to get what you want. All right, so I'm going to leave that for you to finish, but I'm going to do the third one. So just to recap, and then we're using my solution set. Try not to look at the solutions, but I'm going to flash them right now in front of you. So not much new. I just presented, I guess, what, a couple new formulas, not much. So to complete the table, you have these instructions here that I gave. So for the second column, but you shouldn't look here, you should try and do it on your own, but this is basically the summary, okay? For the second column we used, for the missing values, we use this formula that comes from the Proposition 2 with no taxes. And then for 3, we use CAPM, or you could also use the Proposition 2. For column 4, the understanding is because we're working with a firm with no taxes and all those assumptions in M&M world, Proposition 1, then the value of the firms are the same whether there's debt or not, and so too the WACC is going to be the same. It's not going to change. So that's that result. The 5th column is for CAPM, and 6 is for CAPM with beta. With the bonds. And for WACC, you can use CAPM as well, but remembering you're going to use the beta of assets. So you can get the weighted beta and then put it in here to solve for WACC. Or sorry, you use WACC, to solve for beta of assets. Anyway, the point is, because the WACC is the same, the beta will also be the same, no matter how much debt is issued. All right? In the lower chart, you can plot this, and what you're going to see is the plot where RS is going up, WACC is staying the same, and that's all you're going to plot here. I didn't put it, but basically you should get the same graph that we got for cost of capital, Proposition 2 with no taxes. So then the next exercise is to use Proposition 1 with taxes. Now recalculate using the formulas with taxes included. Okay, so these are all adjusted for taxes. So maybe we can do a few. It's a smaller table. And then you make a plot. So what you're going to see in the end as you saw in the notes, so this is what you're going to draw on the first and the second graph, I guess, of that exercise. And then don't forget, this is the debt equity ratio here, so you have to have the correct values. And then with taxes, this is how things should look. The WACC should be going down, RS is going up, beta, the cost of debt after tax should stay the same. So you should be able to graph this. So that's what I'm doing. You're just illustrating with some numbers, examples, numerical examples. Somebody's here. Sorry, I had an interruption. Okay, so you have let's do this review for the third problem. Okay, so there's a smaller table. Okay, so where should we start? Let's start here. So again, how should we get this? Now I've put the column debt to equity here, so it's different. Okay, so you don't have to do this. So this is actually B over S. The other chart, it was percentage. Okay, so to get this one, you're going to use a formula that adjusts so this one we just talked about. But adjusted for taxes. Okay, and that will give you the return on equity. So what do you get here? What do you get? $24.2 sounds good. Okay, and then from there you can remembering that debt is constant, cost of debt or cost of debt is constant. These are pre-tax numbers, so you need to do the 1 minus TC. So where should we go next? We can get the beta for equity and then the WACC, right? Or we can do these two, and get the WACC. So we could get the WACC is now going to be the weighted. So now you have to think about how to get this ratio from B over S. So that's what you're going to use for column 4, sorry. And what do you get? So this one's easy because it's 50% debt to equity. Alex, that is not correct. You got to get your ratios right. I think this is what you have to resolve. Okay, I'm going to teach you this trick, how to deal with this. If somebody has a better approach, let me know. But if B over S is 50%, you could do it like this. Then you think of that as 0.5 over 1. So wherever you see B, put 0.5. And whenever you see S, put 1. And that will help give you the ratio you want. So S over S plus B is going to be 1 over 1.5. And then you can just use that, or you can make it a decimal if you like. Do you follow? So in converting from debt equity ratio to fraction, percentage of the whole, that's one way to do it. So let B be 0.5, S be 1, and then assign Okay, now do that, Alex. Anyone else? Anyone get that? Very good. So let's see if I can Okay, so let's plug these numbers in. So if I'm going to do that and let B be 0.5 and S be 1, so it's 1 over 1.5. Our S was already calculated as 0.242. And I should be keeping, let me do that again, 0.0 No, it's 242. 242. So I should keep up to 6 decimal places. And then plus, so B is 0.5 over 1.5. RB is 6, and 1 minus TC is 4. 40. Good. Very good. So you guys are getting it. Okay, so that's the formula for that. And the rest is just using the CAPM. Let's just finish this one row. So that's, okay, let me just put it there so people can see it. Screenshot if you need to. This is a 1. So you learned how to use ratios and fractions. Let's see, so now I found this is 1733.33. And with CAPM, I can find this. And then with CAPM, I can find this one as well. So let's get this one first. So let's get this one. So hopefully, keep all the pages of all your work. Okay, so let's get equity beta. To do that, you would calculate RS equals RF plus beta S, market risk premium. Again, don't worry that sometimes I use the formulas with capitals and other times with lowercase. It's just that in this unit we start looking at computing the return or the cost of capital. So we use a lowercase to distinguish it from what we were doing before with averages. So we have all these numbers, right? This is 0.06. This is what I want. I have this number RS. Sorry, 2.2, 24.2. And then the market risk premium. So you can solve this to get the beta. So what's the beta? So what do you get? Somebody get it? Did we do something wrong? Why are you guys getting that number? 24.2. Return. Oh, I used the wrong number here, did I? This is the risk-free. This should be 4. That'll fix it. Sorry. That's not return on debt. This should be a 4%. Risk-free is 4. So that'll be 2%. Yeah, I just used the wrong number, Alex. Sorry. It should be RF. So everybody check your answer. Sorry. There you go. And you get 2 point, so this is the beta, so there's no decimals or anything. I mean, there's no percentage. It's just 2.02. Even though I have a percentage in the notes, I have to fix that. It should just be 2.02. Okay. Okay, so we got that column. Now let's get the last one. I'm gonna have to correct those notes because I have a percentage there. So this is 2.02. So please let me know if you have any questions. In the test tomorrow, please let me know if you have any questions. Some students didn't clarify with me one of the questions that was incomplete statement on the last test, and I opted not to give them the points because I told you to contact me if you have any questions, and some people did contact me and I did clarify. So make sure you let me know if you have questions. So let's get the last one. The weighted average beta. So we could get this by CAPM with the WAC. Or we could get this by weighted beta. So let's do both. And then I'm going to let you go. How did I get RU? RU means, RU is the return to the unlevered firm. So that RU is this one, the top one. This is RU, because there's no debt. Okay? Alright, what we're going to do now is get this one here. So from WAC,
We could also use the CAPM with the beta of assets and the market risk premium. So we have all these values, and you can calculate this. So this would be 17 equals RF is 4% plus the beta that I want, and the risk premium, market risk premium. So when you solve this for beta of assets, what do you get? Very good, very good. Okay, now we got it using CAPM, but we should also be able to get it using the weighted beta. We have the beta This is the important thing to realize, okay? We have the beta here as pre-tax. So these betas are different than the after-tax beta. They would be different than what I would compute from using the CAPM to get it. So this is pre-tax beta. Okay, so you need to know the difference. So let me show you. Let's wait a little bit till people catch up, and then I'll show you that.
Okay. All right, so what am I talking about? What I'm talking about is that if we want to compute the beta of assets using the weighted beta formula, you would need the after-tax beta on debt to do that. So where would you get this from? Now obviously this is the longer way, but sometimes I might, well, you could be in a situation where this might be faster. I might give you the information in a way that you should do it this way. So where does this come from? Does anybody know? How am I going to calculate that? What do I have here? This is the pre-tax cost of beta. Sorry, this is the pre-tax debt beta. It will come from cap M. So the beta of debt this is cap M would trace to or be connected with the after-tax cost of debt. Okay? So, to find the beta to put in the weighted beta formula, you would have to do this first to find it. And then you should be able to put it inside. Let's do that, even though we already have the answer. Let's confirm that we can do that. So step 1 is do this, and then step 2 is do this. And so taxes are 40%. So this is 1 minus 0.4. Can I just say 0.6 of RB? RB is 6% always, right? And that should equal RF, which is 4%, plus the number I want to find after tax times the market risk premium. So it's just 0.6 times 0.06 minus 0.04 do something wrong here. Okay, so what do you get? What would be your beta after tax? It's a negative, isn't it? Does anybody else get that? Okay, let's continue. We did it right. So then beta after tax, I'm making a mess here, am I not? So let's let me just take this formula and say what I'm going to do now is take that, so beta, it turns out to be negative, so this is after tax, is 0.04 negative. Okay, it's 0.04 negative. That's the after-tax beta. So now let's put it in the weighted beta and see that we get the same answer. Hope so. So you put it in here and test if you get the same answer. So I'll do that on another page. So we would say the beta of assets after tax this is the after tax should be equal to how did I write it? Dear I wrote the debt first, didn't I? It's okay, you can write the debt first or the equity first, it doesn't matter. What did I just do? Totally confusing you guys, sorry. That's not what I wanted to do. Okay, so this is S over S plus B, beta S plus B over S plus B, beta B after tax. And using, oh no, I closed it by accident. Unbelievable. And I lost all my edits, but okay, fine. Oh jeez. Okay, so I have a clean slate. So what I was doing was beta of assets is a weighted beta. And I can put equity first or debt first. These are B's, and this is beta, debt, and this is after tax. So we said that we would use for this the ratio. So we said B over S was 0.5, so wherever we see B we put 0.5, and wherever we see S we put 1. So S is 1 and the bottom is 1.5. Beta S we figured out was 24.2, right? No, sorry. .02. And then the beta of debt we figured out was 0.04 negative. Now when you put all that together, you should get the result that we got doing it the other way of 1.33. Let me know. And you do get the same, okay? So you get the same, you have to get the same. The difference was you didn't realize that the way you did it using the CAPM and WAC already incorporated the after-tax cost. So you should be able to do it both ways. Okay, so I've held you over long enough. I'm going to ask you to continue making those calculations, verifying the table, and there's a couple more exercises that I gave you that are of the same type of questions, same formula. Right, and I gave you all the solutions, so that's it. You can review this video, review the other videos. Let me know if you have questions. Tomorrow I'll post the test, and I'll be available if you have questions. Don't forget to text me. You can reach me, okay, by text at this number. It was a pleasure teaching you. I hope you feel the same when this is all over. Celebrate. And we'll see you in the new semester, hopefully. Okay, take care. Bye.